Hey there, welcome back to this week's episode of Finance Fridays. I'm your host, Lucas Bolahood of the Bolahood Group with Coldwell Banker RMR Real Estate. And I'm joined, finally, it feels like it's been forever, by Ms. Alexandra Job with RBC. Alex, I feel like it has been forever. How are things
It's
going?
been about a month, right? We've seen some changes since we spoke last, some big changes since we spoke last. And I know you're out west, and yeah, it's been a busy few weeks here.
It's the middle of summer, right? We've had some pretty big, rainfall the last couple days here in southern Ontario, but it's been a scorcher, a beautiful day so far here. Yeah, and we were in Vancouver as well for a conference, which was phenomenal. Met some amazing people out there, and obviously it was great to not necessarily unplug, but haven't had a childless vacation
And it was not even
before
full
with my
vacation,
way. So
it was work.
yeah, it was awesome. So it was a work, but we were kidless, so it was great. We had a blast with that and had good weather along the way too. So
Oh,
that was great. Not going to talk at all about our flights with Air Canada because that's just low-hanging fruit at this point. But otherwise, it's been a great start to the summer, and we're keeping busy and enjoying that. And sounds like you are too.
yes, yes,
Yeah.
yes. So
So
I jump into some interest rate updates. I'm sure everyone knows by now
where have we
we're
been
not
with
new
that,
news,
eh? I think that was
right?
our last recording was like, I don't know if it was the day of, it was June 7th, a Wednesday.
Yeah, maybe it was the day.
I think that might have been day of when we had that our last call here. So we had that quarter point increase on June 7th, right? And then we had another one just this last week.
Yeah, and the one in June 7th, like that was people were making predictions, and then by the week before, everyone was like, "Yeah, I think they're going to do it." And then I think this has just really impacted clients, owners, and citizens because like it was two back to back, and in such a short time, like start of June, start of July, and I think it's just like really hard on people. I mean, prime's at 7.2%. And not only as the variable prime interest rate has gone up, our fixed pricing has changed a lot too, on all terms, in the short terms that clients were interested in wanting to come up for renewal in a year or 2 or 3 years, and the 4 and the 5 year fixed pricing. So everything is higher right now.
Yeah, it's
It's
across the board.
crazy.
But
Yeah.
inflation's on its way down. I think in June they announced it was at 2.8%, and the Bank of Canada's goal is 2. So we're heading in the right direction. This could be a good sign, looking down the road, but you never know.
Next announcement will be in September, so we'll see what they do. Hopefully, they just stay on the sidelines now, and then you know, it affects, like we've talked about in the past, not just people buying homes, but those clients that own homes and they're coming up for renewal, or they're feeling that pressure, or they're on a variable rate and they don't know what to do. So we're having so many of those conversations right now with our clients.
Yeah, and you know what? That's been reflected in since the June 7th rate announcement. That's been reflected in those stats from June. Like the average price did increase. We're just a hair under $1 million on a month-over-month basis, but sales are down 16%. I think we were just under 900, and our new listings were up 13%. If you talk about that month of inventory number, which is essentially if no new homes came on the market, how long would it take us to sell all the properties and have nothing left for anyone to buy?
Mhm.
We went from 1 month to 1.5 months in that 4 week period. So it's a 50% increase, which is pretty substantial when you think about it. So a big increase in new listings, but the demand seems to have tapered off a little bit here. And that's even reflected in our tracking of our transaction numbers on a weekly basis since the beginning of May. We were tracking regularly in the high twos, low 300s in terms of how many were being properties being sold on a weekly basis. Now we're down, under 250 into that low 200 range. So it's definitely changed over the last 4 to 6 weeks, and that's a combination of things, right? Affordability obviously is one thing. People are just like, oh, when's this going to end? Maybe
Mhm.
we'll just sort of wait this kind of thing out. Wait it out till rates come down in 2024 or 2025. But I want to temper people's expectations on that possibility because, I've talked about this before. We've got a lot of new people coming into Canada that are going to need homes,
I know.
and our
It's a
developers and
wicked
builders
storm.
can't build them fast enough.
We've been talking about that on our end as well. It's a wicked storm of you've got demand. The demand is just huge because you've got so many people coming into the country, right? supply shortage, and then you've got the policy on top of it, like policymakers, the government, and what they're doing with rates. So it is, yeah, a wicked storm ahead. And I don't know. Yes, we have cooling off periods in the market, but our price is going to just drop dramatically. I don't think we're going to see that, even with
No.
rates where they are. But it will affect.
We were talking about immigration and how prices are likely not going to go down at all, right? And they're probably not going to drop very much as a result of those who are in the market that can afford to buy, and you need two to tango, right? Like a home seller might need need a certain amount of money because they owe so much already on it, so they can't
Well,
necessarily waver on their price, and someone might meet that ask, you know?
I mean, I hope and I think that people still have healthy equity in their homes. I don't think we're in that like subprime type environment where you've got a client that owes 900,000 and their house is only worth 7, you know, or you know, like
That's
where
the upside. They're not upside down,
no,
right?
I don't think we're in that. We're not there. We're not there. And I have to say, I did see a report like defaults are still very low because what's a priority to your clients or homeowners is paying their mortgage and staying in their house. Is it affordable? Not always, right? And especially with rates increasing. Maybe it is, you know, becoming more of a burden for them to carry that debt load. But the things that go first, which we will see more of from a banking perspective, is clients missing payments and default on, you know, credit cards, loans, and other lines of credit. That will come before the mortgage stuff. And I hope that clients are smart about it. If they need to downsize or they need to get out or they need to use their equity to do something different, then speak to your realtor, speak to your mortgage specialist about that. And I think, you know, as a mortgage specialist, I'm not afraid to say, I think it would be best if, you know, we get out of the, get your other debts cleaned up, because you don't want to be filing for bankruptcy or defaulting on your mortgage, having bad credit. You really got to be smart about it if your financial situation has changed. Hopefully interest rates don't set you into that category, but you don't know if someone's lost a job. Unemployment is another topic itself. So
Yeah, well, fortunately in Canada, unemployment is rather low, almost too low to where they'd like it. And I've sort of raised an eyebrow to that before, being like, why do you not always want people to be employed? But you know, that's not necessarily the case. So, but what I wanted to talk about today that's kind of related to this topic, after we saw those increases last week, I observed a couple of stories in the news where they're
mhm,
talking about this term called negative amortization.
mhm.
And that sounds kind of scary because it's like a negative what on my mortgage. And so I want to talk a little bit about that today. So, you know, Alex, given that your expertise in the area here, can you explain to people what a negative amortization means on their mortgage? And this is
Yeah.
for folks like this is more related to your payments and what's going on with your payment if you're in a variable rate situation, correct?
Right. So for our clients that are on a variable, we've talked about a trigger rate before. So what that is, that when you're hitting the trigger rate, is that your payment, sorry, the interest has gone up so much that your payment is no longer comprised of principal and interest, it's interest only. So what we do at Royal Bank is we would change the payment to collect enough for interest only, so that we do not have to add interest to the balance of the mortgage, right? So you're not paying interest on interest. You're paying interest on the loan only, but you're not paying it down. There's no principal payment there. So what happens is, on your mortgage statement, and you would probably likely be getting notification from your lender, that if you haven't adjusted your payment to reflect principal and interest, your amortization has gone to a negative amortization, not minus, but past our starting point. So typically, like the greatest amortization is 30 years right now. Your statement could reflect a 45-year amortization because you've only been paying, say, $800 is your set payment, and it really should reflect $1,200 now biweekly. We, again, will collect enough interest to cover that, but that amortization is growing and growing and growing on a statement, okay? So what I would say to those clients is, if you want to pay your amortization down, is increase the payment. So set that higher principal and interest payment. So every month you're making, you're chipping away at the balance, right? You're not letting it grow and extend. And another thing would be, have that conversation about fixed. And sometimes, depending on that client situation, fixed payment, remember, when we look at fixed pricing, we will set the amortization at a 30-year maximum. And this is for an uninsured deal, so not a CMHC situation. There are 25 years. Sometimes clients are like, you know what, I don't want to put my payment on that. I'd rather make an interest only payment, and we'll see when I come up for renewal in 3 years what rates are doing at that time. And that's okay, because sometimes that just keeps the client in their house, and they're okay with, well, let's hope our home grows over 3 years and it's better than paying rent and I still own the asset. So it could just be carrying the mortgage interest only, and hanging on to the asset. And if that's the case, sometimes that's okay. But the other options are, considering going into the fixed pricing, and that may be a 4 or 5 year fixed right now. Like I was saying, start of the year, a lot of clients were doing the 1, 2, and 3 year terms, and that might not be feasible for you because those are a lot higher right now. So if you're looking for a lowest monthly payment on a fixed option, you're probably going to be going into a 4 or 5 year right now.
Yeah, I was doing a little bit of research for a client the other day and looking at some brokers offerings. I think the cheapest you could find on a 5 year was 5.29, I think, and those shorter term offerings were like another half point higher,
Yeah.
kind of thing on the
Yeah.
3 year terms.
And keep in
So
mind, when you're looking at pricing online, sometimes there's sort of fine print or there's catches to that, and it could be that that mortgage offer is for insured deals and for purchase transactions only. And you might be at a situation where you're looking to refinance or switch your mortgage, and the pricing could be different when you come through with that application.
yeah, see, again, like we talk about this all the time, you need to be in touch with your trusted professional. So in this case, being a mortgage specialist like you, Alex, and understanding what the options are given your situation. Because yeah, it's not just about, oh, I want to buy a home and what can I afford to purchase, but those refis or the line of credits and those kind of things,
Mhm.
got to figure out where the whole picture, what the outlay is or what the outlook is there.
Mhm. So be
Uh,
reviewing it.
yeah.
Review.
Now, the last thing I want to jump into today, you kind of touched on this a little bit around amortization periods. Now,
Mhm.
we've been most recently in the 30-year amortization where, that's how many years or how many months you're spreading that payment, the mortgage payment across, right?
Right.
Of that loan. And I've been hearing some rumblings about banks extending that amortization period 50, 60, 70 years.
So it
So
wouldn't
what
be
does
the
that mean?
Yes, so it wouldn't be the bank saying, come and get a mortgage. We're going to stretch that out for 50 years for you so you get a really low monthly payment. It could be those variable clients that haven't adjusted their payment and now their statement reflects a 50-year amortization, but we're not setting our loans with that expectation. It's just the payment that hasn't been adjusted. If you were to switch lenders, refinance or purchase, your maximum is still 30 years. I mean, when I came into the business, I think it was 35. So maybe, Government of Canada will put that into place just to help clients with affordability. I wouldn't mind seeing it. I know it stretches out your clients' total debt and how long they're borrowing for, but I think at some point we may need a little bit of relief. So I would be up to the borrower. It makes a huge difference in how much you are paying over the long term, over that the amortization. But
Adding 5 years is one thing, but
yeah,
adding 20, 30, 40 years to that amortization period. Imagine you have a loan you've got to pay off for
yeah.
that period of time and you've got to refinance it still every 5 years or whatever it is. But how much interest you're going to pay in the next for that additional 40 years, even though your payments lower, would probably,
It would not be a
knock,
pretty.
yeah, knock
No,
the wind out of
you
you.
do
I'm
not
all,
want to see that graph. I have graphs. I have amortization charts. It would not look nice. So we're not quite there yet. The big banks aren't offering that. Like I said, your statement may reflect it if you haven't been increasing your payment and you were on a variable and you're at an interest only trigger rate. That could very much be the case. But when it comes to signing into your new term, so if that was you, you're on a variable, your statement says you're at a 45-year amortization because you haven't adjusted your payment. When it comes to your maturity date, so your renewal time, you have to negotiate either with another bank or your existing lender. And at that time, they're going to look at the options for you, whether it's variable, unlikely, but likely a fixed rate at that time. And we will have to go back to that 30-year because that's regulatory at this stage.
Mhm. Now, Alex, is there anything else people can be doing right now to try and, improve their affordability or, their ability to buy a home right now? Like I'm doing some thinking out here in the think tank, like, what can people do to buy a home even though borrowing costs have increased? Like I'm thinking of if you can save for a larger down payment to help with that application be one thing. Maybe people are going to have to start moving to more affordable markets.
Yeah.
Is Durham going to get priced out of an affordable market? Heck,
If
there
my
are things like
family,
improving your credit scores and things like that, right?
yes, if I didn't have family here, like I'd definitely be considering different areas of Canada just for affordability, just to help with price, it'd be cool. And different stages of life bring you different things. Are you retiring? Are you downsizing? Are you starting a family? Those things, impact your decisions. But just staying on top of if you're in the market to buy, these pre-approvals, these rate commitments, the affordability. If rates change, your borrowing power changes. So speak to your mortgage specialist about that, because if you're not buying within that time frame and your rate is expired, you want to revisit. Continue to save, continue to stay on top of your credit, get rid of the higher interest debt if you can. Watch out for those big car payments that take away your borrowing ability as well. They're big ones, and I find guys are like, always after the big trucks, and they're carried for so much money. So anyways, review those things before you make any major financial decisions in regards to buying or even looking and working with your real estate agent. Review it all.
You certainly need to understand what you can afford, and you don't want to run into that emotional roller coaster where you think you can get to this level, and this is the house you want, but it's not within reach, not at least within the marketplace you're searching in. That's all things we need to consider right now. And I like, as you say, working on getting rid of that high interest debt. You know what I've seen actually recently, just some properties listed in Durham over the last few weeks, are these sort of co-ownership type situations. So I saw a property, I think it was in Port Perry, listed for about, it was a 10% interest in this property listed for about 80 grand. So I think they must be valuing that property around $800,000.
Okay.
It's just interesting to see these, investors coming together and someone's decided to cash out their share, and people are listing those sort of joint venture co-ownership situations up on MLS now. It's interesting to see what's going on. So I haven't seen that in my career yet, at least not actively out there on MLS like that. It was interesting to see. So Alex, anything else we got to cover today? We've had a bit of a long one here, but it's obviously we had a lot to catch up on.
I know.
But any other plans coming up for the summer?
Well, we've got golf. I'll be at the golf course with you.
Oh, that's right. Actually, we do have our Coldwell Banker charity golf tournament at Black Diamond Golf Club tomorrow. I've looked at the weather. I'm trying to avoid looking at the weather because that just gives me anxiety now because I love it's so much fun to go, but if we get a rain out, that's gonna suck. But I'm really looking forward to it. It's gonna be a fun day.
But I hope the next time we come on, we can report on how we did. Because I am like, the last time I golfed was last year at
I was
the.
gonna say we're gonna have to find a marked
I
improvement on
don't
last
get,
year's scores.
I don't get out, but we'll see how we do. Okay.
It's a great time whether you're a newer golfer, go out once or twice a year as you do, Alex, or someone like my brother who's coming to play with us, and he's probably played 30 rounds this year. It doesn't matter. There's lots of different skill sets there, and it's always a great time. So I certainly am looking forward to it, and for those that are going to be attending, I look forward to seeing you all there. We'll probably be 100 or so golfers in the tournament tomorrow. It's gonna be a good time.
Awesome.
So, yeah, so with that, folks, thanks so much for taking the time to watch this video with Alex and I today. You'll find our contact information at the end of the video, and you're welcome to like, subscribe, and reach out with any questions that you might have directly. So, with that, have a great rest of your week. Bye for now.